All right. Welcome, everybody. I see we have folks signing on. It's 2:02 Eastern time, so we'll go ahead and get started. Just want to welcome you all to this year's version of the CRE Capital Markets Outlook. And first, thank you for your time today. Time is precious, and we just appreciate that you're spending it with us. My name is Landon Williams. I'm with the Cushman Wakefield Alliance firm that's in Memphis, Tennessee, and I run an investment sales team here across multiple asset classes. And I'll tell you how today came together. We have a top-notch, in my opinion, we don't get a higher caliber of panel than we have today. But ultimately, as we were kind of tossing ideas around on how do we add value to the market. This is an opportunity that we do every year, kind of coming up on the end of the year, looking back just after Thanksgiving, kind of giving thanks of where we've come from, and then looking ahead, the turn of the calendar. What does it look like moving forward? And one thing we've talked about is investors. We have investors on here that are from all over the country and some from different parts of the world. So we thank you for being on here. But investors who are focused on a singular asset class, or maybe investors that touch different asset classes, are still curious to hear what's happening in the other major food groups. So we thought it would be productive and helpful for you all to get this panel on today, these different experts, and talk about the different asset classes. So first of all, you should know this group of five brokers who are on who are going to be your panelists. They've been involved over the last 10 or 15 years in around $200 billion worth of deals. So if you add me to that mix, it's slightly over $200 billion worth of deals. So I'm honored to be on the call with them. And in preparation for this, I gave them a little directional guidance, just like I mentioned, the idea of where we've been, where we're going, maybe some current trends, investor and lender motivations, those types of things. But I left it up to them to produce the content that they felt is most relevant for the audience, for you all. And without hesitation, each of them said yes right away and just had that abundance mindset. And so I'm appreciative of that. And candidly, our team tries to have the same mindset, and really an abundance mindset that's oozing through the Cushman and Wakefield platform globally. So, this is our gift to you all as our clients and fellow deal makers. And the purpose really is to provide clarity in this season of the capital markets that's really seems to be in transition, another transition. And so I mentioned that I lead a team, and I'll say for our team this year, we've seen significant activity. It's been nuanced. And we sort of, as a group, say it's been the year of creativity, because investors and lenders alike are looking for increased certainty in what's been an uncertain environment. So as a result, we've really had to put deals together creatively. If you use sort of kind of proverbial 10 boxes that need to be checked for an investor to move forward on a deal, in 2021 or 22, maybe 5 or 6 or 7 of those need to be checked, and then we move forward. And in today's day and time, what we found is 9 or all 10 of those boxes need to be checked with pretty bold check marks. And so we're having to kind of think through that and navigate that these waters. So I'm going to share our slides here. Let's see. And then, can somebody give me a nod? Alex, do you see this on the screen?
Yep, you're good.
Okay, good. All right, so you'll see we're going to start with multifamily and then go to industrial and then cover office and then look at the debt markets. And then what we will do is at the end, we'll have some time for Q&A. So you'll see on the screen there the little Q&A button. If you have questions, lob them over there, and then time pending at the end, we'll we'll go through that. So last thing here, my notes. Oh, since while commercial real estate is intensely local and investments can look different, from market to market or asset class to asset class, there's still these broad brush trends that we see across the country. And so that's really, a lot of that's what we're attempting to cover for much of the day. So I'm going to start with multifamily, and I'm going to be reading some of their bio, but truly, I do not know a stronger 1-2 punch in the Sun Belt than these two gentlemen. Robert Stickle is an executive vice chair with Cushman Wakefield's Sun Belt Multifamily Advisory Group in Atlanta. He's been involved in nearly $80 billion in multifamily transactions over his career. That's 80 billion with a B. He also sits on the regional leadership team, overseeing more than 100 professionals, which tells you how highly trusted and respected he is inside the firm. And then alongside him is his partner, Alex Brown, a vice chair and candidly one of the most active institutional multifamily advisors in the Southeast. And since 2010, Alex has worked on more than 65 billion in transactions and is a consistent top producer and trusted advisor to major capital partners. So if we want to understand where the multifamily asset class is and where it's headed, these are the guys to listen to. So Robert, Alex, we're glad to have you, and take it away.
Thanks, Landon. If you go to the first slide, we can get things kicked off, but you get a little 2-for-1 here on the multifamily side where everyone else is flying solo. And I'll certainly share the floor with Robert here, but wanted to just get started with 5 key themes that we're seeing across the country in the multifamily investment sales space. Number one, the capital has definitely returned. In 23 and 24, groups were hesitant. They were waiting. They wanted to make sure that the market had seen a bottom. The market bottomed last year, and with that, you're seeing capital start to be risk on. We've seen bidder pools become deeper, which has created competition. And what I really mean there is it's not the CA counts, it's not the tour counts, it's not even the initial offers. The deepness that we're seeing in the bidder pool is in the best and final. And what that's done has driven more competitive processes because you have more people pushing the pile with higher quality groups there at the end. So best and final participation on the deals we've worked on has essentially doubled. It went from 2.5 to 3 on average last year to 5 to 7 this year. Going over to the renter market, we've had a 24-month high for demand, and we had 2 of our 3 highest demand years nationally ever last year and this year. That's been supported by 2 things. One, higher cost of homeownership, and then concessions in the renter pool. So essentially, because renting is a value right now, we're seeing demand really pick up. You couple that with the 4th bullet point, we're entering a season of subdued supply, meaning supply has continued to drop off year over year across the country. We're seeing deliveries below the historical average, and we believe that 26 to 28 will be a great period for rent growth. Now, the third parties don't necessarily have that opinion. So if you look at CoStar or Axio, they're still underwriting 5-year average rent growth in the 2s, but we're seeing winning bidders on average underwrite their 5-year projections in the 3s. So the groups that are winning deals are saying, hey, I can see the supply demand factors. There's a lot of pent-up demand and growth in the market, and we're going to be better than third-party projections.
Thanks, Alex. You covered a lot there. You always do a great job of it. We broke down the capital markets across the course of this past year, and really as we look forward to next year, seeing a similar pattern. So for 2026, we looked at capital markets, property performance and operations, and then deal flow. And really, people like to use a lot of sports analogies or even the financial quarters. We think it plays more like a hockey game. There's typically a season of 3 periods: January to April, May to August, September to year end. And so in the first period, your capital markets are typically best, but your property performance is in the winter doldrums. And the deal flow's generally been limited. We've seen a lot of the Q4 BOV habitual behavior moved to Q1 after the NMHC conference. People really want to see what the pulse of the market is before they begin to explore their disposition strategies. So in the middle third of the year, you have strong capital markets, improving fundamentals, but it typically is the most deal flow availability. You see a lot of launches in the spring and on into summertime. And in that third period, capital markets can be reduced as debt and equity have found places to put their dollars earlier in the year. The allocations start to dwindle. Property performance can trail off a little bit as you get into the natural seasonality of our business, and then that deal flow tapers down.
The next few slides will be quick hitters that substantiate some of the themes we talked about. We'll start off with a look at demand. This is national demand every year since 2001. If you look at the past 2 years, we absorbed 325,000 units annually, which was a 67% increase from 2023. So really strong demand. And again, substantiated by high cost of home ownership and relative affordability for rentership.
Yep. As you look at construction, the supply side, as you look on the left, you see that the starts spiked, but then they're dropping off precipitously. That continues on with construction activity in the middle. And those deliveries, which take a little bit more time from start to be getting to CO, certificate of occupancy, and eligible for new residents, that is not only dropping off, but in the far right side, you can see as the deliveries wane, you're really headed into a blue sky opportunity for that season of subdued supply that Alex referenced.
So here's a look at the construction pipeline broken out by region. So this is normalized as a percent of under construction relative to inventory for those regions. If you look at the far right side, the most recent period, construction activity peaked in 2023 and has fallen precipitously. The South, where we're based, had the highest peak, but also had the steepest drop off, where we delivered a third of the units, or we have a third of the units we had under construction in 2023 as we sit here today.
And then you look at the assets by class. So on the left-hand side of the page, we're looking at vacancy rates by asset class. The 4 and 5 star consider that Class A asset. So that's the dark red line, really performing in a more challenged environment because those are the assets that are in lease up. But you're really seeing the performance begin to head in the right direction for that red graph as they're getting occupancy. And then on the right-hand side, it's the demand by asset class. And you really still see a switch for our nation as it's much more comfortable to be a renter by choice. For many, many decades, you were a renter by circumstance, and home ownership was really the only ultimate goal for everyone when it came to shelter. Now there are high quality alternatives, and the flexibility and the economic consistency that renting provides. You can now be a renter by choice and not shamed at your Thanksgiving table with family.
All right, so we'll pivot to the transaction market. So this is transaction volume nationally, looking 3 different ways. I'd point to the chart on the right side. So that's trailing 12 year-over-year transaction volume. Beginning in July of last year, summer of last year, we started to see the market bottom and start to pick up. And so since then, you've seen a 25% increase in transaction volume. So you're seeing transaction activity pick up nationally.
This is cap rates. We always get the question about cap rates. First of all, for almost every deal, there are 3 cap rates. There's buyer, seller, and the truth. So along with our teammates, we really try to run that consistent calculation similar to how a banker, or lender, or appraiser would run it. A lot of different lines here. They're for all the different regions in the country. You can see the general theme is cap rates have been compressing over a 20-year period. They obviously were hyper compressed post-pandemic. They've expanded. But if you'll notice, some of the lines are in a flat status right now. Fortunately, in the Southeast, that green line is the first one headed down. So we are seeing a renewed equity interest in being in the growth markets as opposed to the gateway markets, which have some multiple challenges. There is some hometown bias there, though.
And so what types of deals are trading? Where do investors want to be? This is a look at sales volume over several different periods, broken out by vintage. The punchline is that we're seeing an increased share in trade activity in the newer construction space. This year, 44% of trades will be 2010 and newer, and 57% will be 2000s and newer. So investors are definitely showing a preference for 9-foot ceilings, newer construction, and that's where we're seeing the most liquidity.
All right, to wrap up here, we want to give a fun visual. Everyone has heard the phrase survive to 25. Well, we got to and through 25. And there are still a lot of clients out there saying, well, things aren't radically better. You know, what's happening here? I would tell you a few things here as we look at this visual. For a little while, when there was just a little light at the end of the tunnel, people were hoping that it wasn't a train coming down and going to be the next GFC to hit us. We're clearly not headed towards that. There is economic anxiety still in the system, but for the most part, from a commercial real estate standpoint, especially multifamily as a favorite asset class with favorable debt options, which Chris will hit on later, we really are going into a blue sky season. 23 and 24 weren't distinguishably different, but 24 to 25 has been. We've seen values increase. We've seen volume increase. It's been very encouraging, even though we're not all the way out of the tunnel yet. We're very optimistic about 26 through 28 having both favorable fundamentals and encouraging equity flows as well. So overall, we don't just have occupational optimism. We have genuine fact-supported optimism about where the market is headed here for our sector.
Okay. Thanks, Robert and Alex. Really appreciate that. And as a reminder, we are going to have a Q&A here shortly. So we've got a couple questions here. If you have any questions specifically for these guys, send them over, and we'll time pending, we'll ask them here at the end. So next, we'll move on to industrial. Candidly, if you follow industrial and real estate at any level, then you already know this guy's name. Will Strong is one of the biggest movers and shakers in the entire global industrial asset class. He's completed more than 115 million square feet and over $15 billion in transaction, and advises developers, owners, and capital partners all over the world. So this is pretty cool. He was also named Cushman Wakefield's youngest executive vice chair in company history. So if anyone understands kind of where industrial rents, demand, capital are truly headed, it's Will. So Will, we're honored to have you today, man. Take it away.
Thanks, Landon. I'm glad someone's believing the marketing emails that we're sending out. Feel free to unsubscribe. Really appreciate it. Honored. Love what you're doing, Landon. It's awesome. I see what you're doing and how you're going about it, and it's awesome to see it. So just good on you and your approach, and happy to be here. This is Will Strong, as Landon said. So I sit in Phoenix. I'm directly responsible for what we call the Mountain West, so the Mountain States, and then I've got a leadership role on our team nationally. So we'll go through it quickly. I'll let Drew Flood give you the 100-year history of Cushman and Wakefield when it's his turn. I'm just going to quickly touch on our team here. This is our national sales team, so it's a really all-encompassing group of roughly 9 teams. This map here just shows how we cover the markets, and we'll go to the next slide. So Cushman Wakefield, I would say in any given year, probably represents 20 to 25% of the national industrial marketplace. So if you want to extrapolate like just how the United States is doing, you can take these numbers here and multiply them by 4 or 5, right? This is enough of a sample size to probably just indicate, although we tell you that we have, we'll tell you we have 50% market share. CB will say 50, JLL will say 50, and then it adds up to like 180%. But I would say that this is probably 20 to 25% of the U.S. And it's very telling. What you see here is our actual volume, that national team that I just showed you. This is what we're packaging. This is what we're pitching. This is what we have in the market. under agreement and closed right now. And you can see everything's up versus last year. And it's up significantly for the most part versus 2 years ago. And if there's any questions, you know, call me, email me. We're keeping an eye on the chat here as well. But happy to kind of dig into, you know, what this, it might be interesting for some to go one level deeper on this pipeline, what areas of the country, what type of products. So this is a very broad stroke of our business. Let's go to the next slide, please. Okay, cool. So just like some themes, trying to keep it really high level. Look, I'm on the road basically every week. Saw Drew and team last week in New York, and you know, look, there's a ton of capital, right? So just, you know, I can't think of any meeting I've gone to where someone doesn't say they have money for industrial. I know it's not a surprise and that's not earth shattering, but you think at some point people would get allocated, or you think people would you know, have interest in other asset classes. We call it a stock pickers market right now. Look, the stuff that's really good works great, like core uber core deals are really strong. I would say that if it's got any hair on it, if it's off the beaten path, it's really thin. You know, and it's not like 2021 where people would just buy anything. That's what we mean by stock pickers market. Like back in 2021, you could just buy the indexes, right? You just buy the index in 2021, you're going to make money. Right now, it's just not that way. You know, you've got to be very methodical, and it's showing up on our bid sheets. And I think it's thinner than people say. And that might be creating opportunity for those value opportunistic buyers out there. If it's got hair on it, if it's got vacancy or credit challenges, I think it's thinner than people are saying, and it's probably a great chance to buy. Shallow bay infill sought after, not a surprise, right? We're coming off this big kind of overhang of supply. A lot of it's in the bulk space. So there's strength in infill. And then look, land prices. I mean, it felt like everyone thought their land was a data center site. I think landowners have come back down to earth now. So land prices are half of what they were. They're a third of what they were. Development deals are penciling. So for those buyers out there, feels like a great time to buy land. It's incredibly hard to find capital, but we're seeing a lot of developers find ways to buy things on balance sheet. Developers that have never bought on balance sheet before are trying everything they can to back the truck up and buy land. I think you've got 12 months, 6 months to back the truck up if you're a developer and buy land in a lot of areas. Because I hate using the saying, but it feels like we're in the very first inning of a new development cycle, and the institutional capital is still very reluctant. So if you can find a way to capitalize it, I'd back the truck up and load up on land right now. I think you'll look back. Next slide, please. Just really quick, this is just dry powder. Goes back to what we were saying about there's more capital than has ever been raised for industrial. Let's keep going. All right, this is a broad stroke. We've actually got a Class A cap rate map. I'm happy to share it with people. We've got a spot cap rate map that we actually update every week. So my email address is will.strong@cushwake.com. Copy Landon, and we'll send you. We got to copy Landon. He's gonna want to be in on whatever deal we do. So, you know, I'm sure Landon, you don't realize it, but when you signed up for this webinar, you signed a commission agreement for every deal you've ever done. You're probably wondering why you had to sign a waiver. So Landon's got you now on a master commission agreement. But email me. I'll send you the cap rate map. This is just broad. What's interesting is there's such parity across the country. I'll give you a great example. There's a Class A. It's kind of a mythical core deal in Phoenix. It's about to go off at a 4.9. That's a brand new deal at market rents. There's nothing to it. If you ask Jeff Chiat in California what that looks like, and he would tell you it's a 4.75. So it's amazing looking at the difference in cap rates here. The other thing I would tell you too is there's a big difference right now between A and B, and also credit, non-credit, and as it relates to debt. And what I mean by that is the spread between credit deals and non-credit deals are probably 50 to 75 basis points. But I bet the debt team, and I don't want to steal Chris's point, but I think he would tell you that the debt's probably only 15 to 25 basis points. So there's an interesting arbitrage there between just how awesome the debt markets are and the spread between credit, non-credit, and also A and B. Let's go to the next slide here, please. This is kind of what I was talking about on land. Okay, this is just overall land. So the market's kind of believing what I'm saying about, look, if you're a developer, this is where you scrounge, go to your country club and pass the hat around if you have to. Find a way to buy land sites. I think you'll look back and feel like it was compelling. Let's go to the next slide, please. And then look, this is just kind of like high level. What I was saying is, look, cap rates feels like the whole country for whether it's gateway, primary market, or a strong secondary, kind of ranging in that 4.75 to 5.25, just above positive leverage. We'll let Chris go through that. Like limited cap rate expansion, feels like the core buyers are solving for that kind of high sevens, unlevered. Core plus groups are in that low teens, and then the value buyers want to be in the mid-teens. And it really feels like it's pretty tight all around the country. Now, look, it's different depending on certain markets if you're going tertiary or an emerging secondary, but this is just a broad theme across what our part, and this all this information comes from us surveying our national partnership in preparation for this call with Landon. So this is fresh information. Let's go to the next slide, please. Okay, cool. This is it. Last summary. So one thing I would tell you, just opportunities, right? That's the whole reason why I think you're on this call is Landon's great at digging up opportunities. It's what you guys care about. Right now, there's not a long line around the corner for really big deals. There are buyers there. And I don't want to steal Adam Pastor's thunder, who we just hired to run our portfolio business, who's fantastic. But if you can get big, there's a window. And it's not as competitive, right? It's getting more competitive, but if you can go bigger, it's going to be less competitive. And I don't want to say there's a discount, but I think there's probably just an easier path forward. We really like leased or empty big buildings. I think the big bomber market has just been kind of hit, and it feels like it's getting better. So we really love kind of that super bulk space. We're about to roll out a 1 million square foot building in my world. We study that there's 85 million footers in the United States right now, and half of them are spoken for. So I think once that leasing takes place, it's going to really turbocharge the investment market. I've already mentioned half off land. I already mentioned off the run existing, right? If you can find stuff with hair on it, that feels like, it's thinner. I already mentioned the premium for sub investment grade, right? That's that 50 to 75 basis point spread. If you feel good about the rents, that can end up being a really good basis play. And then one thing I would tell you, like stable B buildings, like you go to SoCal right now, you go to parts of you talk to Gary Gabriel, Northeast, Tri-State, you can get a really nice premium over Class A core if you find good, solid B assets. So, look, I think that's it for me. Grateful to be on the call, and you got my email, and I think let's go one more slide just to make sure I didn't put anything else in here. That's it. Thank you very much.
Thank you, Will. This is where we go over the history of Cushman, I think, with Drew here. But no, hey, as a reminder, send those questions. We got a couple maybe coming your way, Will, and you will also get this in a recording sent to you after the fact if you register for as you register. So, Drew,
let's go.
Before you continue, I want to make sure we tell everybody, they probably already know who you are, but office is maybe everyone's in the most suspense to hear from you on potentially the most debated asset class right now. And Drew Flood specializes for Cushman in office and development transactions across DC, Virginia, and Maryland. He's closed more than $15 billion in investment transactions over the past 5 years alone. And interesting, what sets him apart is he's seen it from every angle: capital markets, structured finance, lending, and even construction, if I'm understanding your bio correctly, as a former GC in New York City. And so we're just excited to have you on here, Drew. If you want to help decipher the different narratives for us today. We appreciate it.
Yeah, absolutely. Thanks for having me, Landon. Appreciate it. So I am the co-lead of our national office practice, and Will, your slide 19. Maybe we should go back to that because it looked like those were levered returns in the tens, I'll say on average. My neighborhood, those are unlevered. My neighborhood's unlevered tens and 11s and 12s. So anyone on the call who's looking for some yield, I'm your guy, or our business is your guy. So, and also that picture of me was probably in 19 when we all wore ties, and the market overall was selling 110 billion, and now we're selling overall across the entire landscape only about 50 billion for all the reasons that we can talk to. So. Next slide here. So really the baseline of what's going on, it's been a tough time here. Those you can see on the left-hand side, the net absorption that was occurring over let's say, those 9 years was probably somewhere in the neighborhood of 40 million square feet a year. And then you can see after COVID, we went the other way. And in lockstep, you could see the vacancy climbing. So the challenge with the vacancy and valuations, and this is the biggest surprise when we ran the math, on a bunch of data. If you take the vacancy factor in your Argus model and you move it 5 points, so everyone bought office buildings pre-COVID with a 95% occupancy. If you move the model 5 points to 90, and we know that most markets are, as the chart here says, is 20 to 22% vacant. If you move that vacancy factor in your model 5 points, it's 12% of value destruction. So you move it 1 time 12, move it 2 times, that's 24, move it 3 times, boom. And we haven't even talked about rents or exit caps, et cetera, et cetera. So you can kind of see that this chart is really the look back as to why we're where we're at. Next slide. So this slide is confusing me, and it very well will confuse the rest of us. So the blue line is the office employment. You can see it was moving up until COVID in 2020. And you can see that we were leasing, which is the brown or gray line, quite a bit of space. And then you can see post-COVID and the recovery that people still, the employment has like rebounded, but office utilization has gone the other way. It's return to work, it's all that type of stuff. It's 3 days, whatever, tightening up your space. But I also think it's like we overleased pre-COVID, as you can see the spread between the blue and the gray line, and now we're probably normalizing. So I think that this indicates that we're probably overcorrected. And so from an office perspective, eating at that vacancy on the previous slide, I think we're heading into a good spot. Next slide, please. And this is really the other like cherry on top, if you will. There's no supply. There's no supply except for at the super duper top end of the market. We have 2 buildings in Washington where I sit, where the previous high rental mark was $66 triple net. 2 new buildings are being done by Boston Properties at about 100 triple net. So we're seeing a massive movement in rents at the very top of the market. It's pulling up the other markets, but it's largely a derivative of this limited construction at the top end. So the top tenants are really fighting for space. I guess we can go to the next slide. So everyone kind of senses this, everyone knows it, etc. But on the left-hand side, from 2007, you can see all office or all product types climbed in value by 35%. You can see office is 10% off from 07. The reality is it's much more severe than that. It's probably somewhere between 35 and 50% in value, which has led me to spend a lot of time with all my new friends, which are the lenders, sadly. So I understand that there's probably some owners on the call, and it has just been a brutal 5 years or 4 years or so. And fortunately things are turning, but it's turning very, very slowly. Next slide, please. So where do we stand in the office market today? A couple of themes. So point 1, the floor has been set on pricing. So the falling knife, which led us to not transactions in 2023 were close to 0, blah, blah, blah. People were just seeing the market just fall out from under them. The knife has fallen. You might get nicked as it bounces on the table a little bit, but for the most part, there's enough comp evidence as to what pricing is. The second impediment for transactions was debt. We finally have visibility into debt, whether it's, CMBS or debt funds. But, even 6 months ago, debt was very, very limited. And we'll talk about that on the next, in a couple minutes. Lastly, and the next, the final question people ask me is, Drew, how am I going to get out? And that thankfully is becoming clear, which is we're seeing great transactions in Texas. We're seeing great transactions in Brickell in Miami. We're seeing great transactions in New York, Nashville. So we're really starting to feel like there is an exit. So you're not going to get hurt on pricing. You got evidence, you can get debt, and you can see your way out of it. So we're starting to turn the corner here in office. Next slide, please. And then here, I probably have these charts backwards, or these folks on the right-hand side. And what we're seeing is the gray is the transactions on the leasing side in buildings that have traded in the last 180 days. So 63% of leasing, gross leasing that's happening across the country is happening in newly acquired buildings. And why is that? And then on the right-hand side of this chart, you can see the larger transactions. It's even more significant. And it's not very hard to figure out. It's first mover advantage. So you got a cost basis of building that across the street's got a $300 a foot basis. The new buys at 85 and you win, right? The second reason is that many owners, as you know, just don't have the capital to transact on leases. So the new capital stack buildings are winning. And again, point three is very similar. Well-capitalized buildings are where the tenant rep folks are leading their tenants to. So my point on this slide is, if you're willing to dip your toe into office, and I know that's not for everybody. I know there's still some people that are working through their portfolio, but the people that are stepping into space are leasing the heck out of it and are going to be rewarded for it. Next slide, please. And this is my last slide here, and this is interesting. There's a little bit of broker math here to a degree, but we look at valuations and we partition the value between cash flow and exit value or residual. And so in 2019, 2/3 of the value was on the come. It was on the residual. A third was from cash flow. And for that, profile, you got the opportunity to buy it, as if I was buying a multi or an industrial job at 5.5 cap, right? 2025, the opposite. Today, you're getting all of your value, or you're getting 2/3 of your value from cash flow, and the residual is plus or minus a third. So conversely, from the 5.5 cap, now a de-risked asset's getting somewhere in the neighborhood of a 9 to a 10 cap. So again, making the case that cash flow makes the transaction safer, more comfortable, et cetera. There's a little bit of pop. Now, again, we're talking in 2025 here at a 9 to a 10 cap. We haven't even talked about, as the market improves, those cap rates falling from 9 to 10 into the 8s to the 7s, and that's where you really are going to make a lot of money. So anyways, office is coming back. It's coming back slowly, and tons of empathy for those existing portfolio folks. But boy, oh boy, it's time to start practicing, or it's time to start buying. That's what I got.
Thanks, Drew. Very helpful, and you covered both sides of it there, and there are definitely two sides to that asset class right now, and we appreciate that. Next is my friend Chris Moyer. We bring it all together here with the debt markets, maybe the most influential factor of some of these decisions that are made. So Chris Moyer is an executive managing director and partner on the Cushman Wakefield's Northeast and Pacific Northwest equity, debt, and structured finance team since 2006. He's been directly involved in more than $18 billion in transaction, and his team consistently raises over $6 billion per year. He's a good friend of mine, although I don't know that he leads with that when he goes into meetings with everybody. But he has an amazing resume, and I can tell you that firsthand that as the markets have gotten choppy, he's sort of helped me sort through it. So it's great to have you on, Chris. Take it away.
I'm absolutely thrilled to be part of the panel today. It's always exciting to hear from this team on the call, and obviously love working with you, Landon, who you are a dear friend, and I do lead with that. A lot of talk about the debt, so hopefully I can sort of perform and bring everything together here. I've been off camera because I've been reading and scribbling notes as the Fed announcement just came out. So I'll start with the live data there, which isn't necessarily on the slides here, but we'll follow up with that after as well. So the Fed did just cut 25 basis points as expected. That brings the new target rate down to 350 to 375. This is the third cut that happened all in late 25 following September and October. They're clearly signaling a shift and prioritizing protecting the labor market over fighting inflation right now, which, while the inflation is sticky, it is secondary risk of a recession. So this is why they're doing what they're doing. Couple takeaways. There is immediate relief for borrowers. The most direct impact is on floating rate borrowers, obviously, with SOFR tracking the Fed fund rate. So we're seeing an immediate drop in debt service coverage cost for unhedged borrowers. To put that into context, a $50 million loan at a 75 basis point drop over the last 3 months translates to a $375,000 savings in interest. So that money can go back into properties, CapEx, or get distributed back out. So meaningful immediate relief there. It also brings into context the refinancing wall, which we've all been worried about for a while. This cut that helps diffuse that bomb that we've been looking at. While 3.5 isn't zero, the direction is what really matters. So lenders are more willing to extend or refinance if they can get comfortable underwriting lower exit interest rates, lower exit cap rates. So this cut likely pushes some of those distressed loans into the more workable category. Hopefully for all the sales professionals, we see a narrowing bid-ask. The psychology of the market does continue to evolve daily. So for the last 2 years, a lot of the buyers wanted a discount for the rate risk that they had perceived, and sellers were holding out for future cuts. Since we're now in the future cuts, this validates the lower cost of capitals, which should compress cap rates slightly and more importantly, unlock more transaction volume into 26 as borrowers feel like the risk is behind us on the interest rate side. I think another interesting takeaway is the data fog. We've all been looking at recent data gaps with the government's shutdown. The Fed did cut despite incomplete data, which shows there is a bias towards the easing environment right now. For CRE lenders, this does remove tail risk of sudden hikes, right? That we're sort of lingering out there a bit. We expect debt funds and banks to continue to loosen liquidity and buffer slightly there, meaning that we'll see some tighter spreads hopefully going into next year. I think that the key takeaway from today is that we are officially in an easing cycle. So hopefully we move from what was a macro crisis, risk with elevated interest rates continuing to go down and level out into really sort of what's more of a micro execution on the asset level. So moving into more prepared notes here, the Federal Reserve does continue to face this dueling mandate with maintaining price stability and maximizing employment. Rates did peak, as we show here, at 533 and 23 after the aggressive hikes that were brought in to combat the post-COVID inflation. And now we're trending towards a lower stabilized number at 3% by 2025 to 2030 is what we're currently looking at. They'll likely continue to lean towards the economic growth to sort of protect against the cooling labor market and continue to look at more cuts hopefully next year. We'll update some projections on that after today. It's really creating opportunity for real estate professionals, as we've just talked about in all the prior panels. Go to the next slide, please. So we see here that yields are feeling upward pressure. This is largely conducted because the Fed's official view has continued to shift up a bit. We've seen that neutral view evolve from 2.5% to 3% in the last 12 to 18 months, which applies pressure across the whole curve. So we need to adjust our expectations about the 10-year is sort of the bottom line. Looking through the current volatility, yields are likely not expected to drift below 4%, pending, the only thing that would happen is a recession that could drive it down at this point. And all of the trillions of dollars of futures markets are actually projecting something more in the mid fives by 2035. So why this all matters is, we do see higher longer term base rates. which means higher elevated interest rates. But in the near term, we do see shorter term rates easing some of that cash on cash returns that we'll get to in some of the later slides. Next slide. So despite the rate environment, the financial markets look calm going into 2026. They've largely looked past the uncertainty, and we're continuing to see spreads come in. Investment grade corporate bonds are historically aggressive right now, and CRE specifically is at a really good time for borrowers. The 10-year CMBS spreads, which peaked at 166 in late 22, are now about 80 bips, which is a return to more historical terms. So despite the volatility that's all over these graphs here over the last few years, liquidity is really strong right now, and the risk appetite continues to persist, driving spreads down. So next slide. The headline here is that fixed rate costs are about 50 bips tighter than we saw in 23. Spreads have stabilized and are now trending towards more long run averages. Just to touch on a couple sort of high level, and there's obviously nuances within each of these. Office generally, we're seeing borrowing cost in the low to mid sixes. We're actually closing an $800 million balance sheet execution in New York City right now on an A++ asset that's pricing in the mid fives. So there is a barbell, and sort of that cost of capital is if your trophy best asset, you can get sort of almost on top of or inside of even best multifamily and industrial pricing in the office sector. So I think very nuanced there, but stories of success. Grocery anchor retail is the favorite in the retail sector. We're seeing that in the mid to upper fives. Strip centers are low sixes. And then industrial and apartments, we're seeing low to mid fives on rates with agency. And these are all 10-year rates I'm referring to, 5 years or lower. Agencies can even get into the high fours with buy downs on the 10-year money right now. So financing costs remain elevated versus pre-pandemic levels, but they've stabilized, and I think are actually heading in a very positive direction for owners and buyers right now. Next slide, please. So just a commercial for our business here. We do a monthly newsletter that Landon can help you get signed up for. Also post on LinkedIn on the left side with all this little data here that you can come over every month with your magnifying glass. I'll just sort of touch on, I looked at last year's versus this year, and I'll just touch on a few highlights. So that the 5 and 10-year T are down 45 bips and 16 bips respectively. So down more at the short end of the curve. We looked at spreads, and they're down 15 to 20 basis points respectively. So what that means is all in borrowing cost for 5-year and 10-year financing respectively are probably down 60 to 35 basis points, in line with that sort of 50 bips on the previous page. We're just getting more granular here. While our report doesn't track it, I just want to sort of touch on the construction market because that's very nuanced. But the multifamily construction market, we've seen probably compressed by about 75 basis points year over year. Some data points there that we're in the market with right now are a 60% LTC partial recourse loan at SOFR 195, so very aggressive pricing from the banks in that market. And then at the higher leverage, we're closing an 80% LTV non-recourse deal at 410 over. Debt fund pricing for transitional assets has compressed about 50 bips as banks are providing better back leverage for the debt funds, and debt funds have reduced their return profiles. So again, 2 data points to touch on there. We're closing a 75% as is LTV multifamily deal with a 4s debt yield going in to stabilize in the mid sixes. That's going to go off at 245 over, but very, very aggressive pricing. And then for TCO, no data on leasing yet at properties. Very similar deal at 315 over. So we're at a really great time for borrowers right now. I think is the key takeaway, and this data supports that.
Hey, real quick, Chris, I'll just say once again that if the audience doesn't get your monthly email of the chart on the left, it's a very helpful resource as a spot check, and also to see what the trends on spreads are doing. So send Chris a note or me a note, and we'll get you on that list.
Great. So the most critical signal for a lot of buyers is positive leverage, which is back, as we can see there, sort of all the way on the right side of the chart. We've seen that as the debt costs have lowered. This chart here tracks the trailing 90-day average of cap rates versus mortgage rates. So as you can see, that gap is narrowing, and we're seeing that accretive debt placement coming back into the market once again, which should encourage buyers back into the market and help drive cap rates down. Next slide. Loan origination activity has remained really resilient through 25. We're edging, year-to-date volumes over last year. Refinancing is capturing the largest share of this, as you can see on the right-hand side of the slide there. It's a significant jump of up 55% from pre-pandemic levels. This is really a result of slower than average investment sales activity, which is leading to more owners extending and holding out their holding periods. But I think we should start to see this normalize here in the next few years. But I think origination activity is very strong right now. Next slide. So while the volumes are up, we're still seeing underwriting fairly conservative from lenders. LTVs remain slightly below long-term averages. Debt yields are sort of in line with or above historic norms. So the opportunity here is that hopefully we see LTVs start to inch back up and debt yields start to inch back down as there's more comfort in the market and stability with interest rates. Next slide.
Is this it?
Yep. Oh, next slide. Yep. So the banks are back in a big way. The large banks are driving a lot of this bounce back. They're actively extending loans to borrowers again as they were out of the market, or there's a little bit of a slowdown back in 22 it was. Large bank origination activity is up 55% year over year. The increase in market activity has likely been a result of higher repayment activity, which has encouraged them to put that money back into the market. The large banks do have a slight edge over the smaller banks right now. And sorry, it's actually the previous page I'm just referring to. There's a bit of an M&A activity picking up in the large market, in the bank market, which is going to continue to drive that into the large banks. Historically, we had our regional go-to banks. We do have our regional go-to banks that we would always say we're late getting the pricing memo, or had sort of more regional reasons to beat the market. But the large banks are pricing deals very aggressively right now. We're seeing them edging out the regional banks on a number of transactions we're in the market with. Next slide. So there is a broadening pool of lenders. It's not just the banks. There's a lot of unique debt funds out there that are expanding their presence in the market in this cycle. Financial lender activity, including debt funds, has brought in 60% relative to pre-pandemic. Seeing this as a result of sort of a run into the private credit market and banks offering more attractive back leverage to the funds. We do expect to see some shift out of private credit into equity funds. In this next year, it's gotten harder for a lot of those debt funds to deploy those dollars into such a competitive market, which will be really good for the equity market as well. Next slide. So strong issuance from CMBS right now, that the trailing 12-month is 90% higher than the trough. CMBS issuance is actually 50% quarter over quarter up in this year. CLO is available again, although the market's a little bit constrained to being selective, but the CLO is also a really good option. Next slide. So the single borrower SASB market is at all-time highs or near all-time highs again here. So issuance is also balanced across the property types pretty evenly-ish. It's not just a story of industrial and multi by some of the balance sheet lenders more so. So that's really healthy for the market. So I think that the takeaway from the debt, and apologies for talking fast, I'm just trying to get through here to give us some time, but we do expect a very, very busy 26. I think that the lower front end of the curve rates are going to help drive a lot of activity relative to the past few years we've been experiencing. That's it.
Okay, rapid fire, team. Rapid fire. 1 minute or less here. Chris, we'll stick with you, buddy. You mentioned large banks are back in a big way. What types of deals are banks competing the hardest for right now?
The banks are bidding everything. I mean, we had a bank syndicate show up on the $800 million office refi we're doing in New York. They're showing up for construction deals. They're showing up for refis. I don't necessarily think that there's a part of the market they're not bidding. They're just trying to get paid appropriately for it and really sort of bid at the right leverage point. And maybe that requires partnering up with a sub-debt lender, but there's so much private credit, it's very easy to sort of marry them up together to get those executions done.
Yeah, that makes sense. We're in our market, we're seeing banks making a play on a lot of the office assets because the investors appreciate the flexibility associated with it, and they might refinance sooner than they prefer, sooner than alternative options. Hey, Drew, real quickly, for an investor who's been afraid to touch office for the last few years, what type of office should they actually be looking for in 26?
Great question. One of my biggest concerns is deal size on the takeout, right? So back when our shop here in Washington, we averaged like $95 million was our average deal size. Now we're doing our average is like 38, which is a little weird, but it is what it is. And that just goes to show you that there's only so many, there's only so much capital out there. So I think that it makes a ton of sense to play in that $25 to $40 million acquisition level, knowing that you're going to be able to find that 40 to 60 to $70 million takeout.
Yeah, very good. And then Will, I don't know, interesting question. What's the one industrial thesis today that you think a lot of investors they're still they misunderstand? Let's see. Are you on mute?
I feel like I sit in Phoenix. I cover the mountain states, so like Denver, Salt Lake City, Vegas, Reno, Salt Lake, Denver. I mean, everything's really been, we've benefited from what's happening in Southern California. We joke around that we're the ones that fund that legislation as a joke, and we make jokes that we're part of the Arizona Chamber of Commerce. However, I think Southern California, there's something happening there. I think it's coming off the bottom. So that'll be really interesting to see what happens because SoCal has really kind of always been what everything prices off of in the United States. So they've got a port, they've got a big population base. Clearly, it's hard to do business. Users are, it's challenging. There's all kinds of issues with legislation. So I think next year it'll be really interesting to see what happens with Southern California and how the rest of the country behaves. And I would tell you that there's probably, if you want to be a real true contrarian, like an actual contrarian, I'd call Jeff Chiat. I'd fly to Southern California and I'd start looking around.
Very good. And maybe surprising for what most people would think. Alex, Robert, last question, guys. In investor interest in the multifamily asset class is clearly picking up again. What would you say is the single biggest factor bringing institutional capital back off the sidelines?
I'll come off mute first. I think it's the supply demand dynamics. You have, well, we showed some slides on it, but you've got record demand and then supply falling off. Those are the ingredients that will help create rent growth, and sophisticated investors are noticing that.
Yeah, Alex, I would just add in, I do believe that it's the opportunity for rent growth, but it's also years of lower deployment of capital, and that wall is mounted, and now that glacier is melting, and so we do think that will they move in a herd? The herd is starting to move.
Guys, panelists, audience, thank you very much. This has been exactly what we wanted it to be. Really appreciate your time, my panelists, the Cushman team. Thank you for your expertise, and we'll follow up with the recording. Let us know if you have any questions. Reach out if we can help you think through any of these investments or the debt side. And everybody, happy holidays and have a great, happy new year.